2026 isn't the year crypto changes. It's the year a lot of US traders finally realize 2025 was the year the rules already switched on. It's not the next bull run that should worry US crypto holders, it's the next tax form. While everyone's staring at charts, meme coins, and ETF flows, the IRS has quietly turned 2025 into the first ever 1099 DA crypto reporting year. A full data feed straight from your exchange. To them. And most people still think this is coming in the future. It isn't. In this video, I'm going to show you what 1099 DA really is, why 2025 is the first on-the-grid year for US crypto, and how to avoid getting blindsided in early 2026 when those forms start landing. Here's the part most people haven't clocked yet. Buried behind all the noise about regulation coming one day is a rule that's already law. Not a proposal, not a rumor, a done deal. The US Infrastructure Investment and Jobs Act expanded the definition of a broker to include digital asset platforms, and the IRS has now followed up with a new reporting regime built just for crypto. The name of the game is simple: Form 1099 DA. From the 2025 tax year onwards, US digital asset brokers, think major US exchanges and custodial platforms, will be required to report your crypto disposals and certain transfers directly to the IRS. And you won't just be telling them what you did. They'll already have their own version of the story. So if 2024 was the era of, well, maybe they don't see everything. 2025 is where that illusion goes away. Let's break this down in real language. Right now, if you're a US crypto user, your tax return is basically an honor system with some spot checks. Your exchange might issue a basic 1099 form, but it's incomplete, inconsistent, and often doesn't show your full profit and loss picture. A lot of people just assume the IRS doesn't have granular data, so they round, guess, or skip entirely. From the 2025 tax year, that changes. The IRS will start receiving 1099 DA forms, D for digital, A for assets, directly from platforms they classify as brokers. That includes US centralized exchanges and custodial platforms that handle things like spot trades, stablecoin conversions, certain derivatives, and possibly tokenized assets depending on the platform's structure. Those forms won't just say, yeah, this person had an account. They'll include key details: disposals, gross proceeds, cost basis where it's known, and in some cases, transfers between platforms. In other words, your activity stops being something you declare and becomes something the IRS can verify. And that has three big consequences. First, it kills the old myth of, they don't really know what I'm doing on exchanges. If you trade on a US-based platform that qualifies as a broker, they will be required to send structured data to the IRS. Not a screenshot, not a vague summary. Structured data, the kind that can be matched against your tax return. Second, it exposes patterns, not just single trades. If you've been doing a lot of in and out scalp trades, yield farming via centralized products, or swapping into stablecoins and back, that activity will show up as a series of disposals and acquisitions. The IRS is less interested in whether you bought one memcoin, and far more interested in whether you made real, undeclared gains in size. Third, it changes the risk curve for, I'll just ignore it. Ignoring crypto activity was always risky, but the enforcement cost was high. It took audits, investigations, and a lot of manual work. With 1099 DA, the friction is lower. If the IRS has a report that shows you generated $40,000 of disposals in 2025, and your return says nothing, that mismatch becomes low-hanging fruit. This is where a lot of people will say, fine, I'll just move everything to a cold wallet and disappear. But here's the key. A cold wallet changes custody, not history. If you've done 3 years of trading on a US exchange, that history doesn't vanish just because you sent everything out to self-custody in December. The 1099 DA reporting is about what happened on the platform, your trades, your conversions, your disposals. Moving what's left to a hardware wallet doesn't erase the gains you already realized. In fact, if you move coins out after a burst of profitable trading, that final transfer may also be part of the data trail, showing funds leaving regulated platforms into self-custody. For a pattern spotting system, that's not a disappearance. That's a flag. So if the old mindset was, they can't see me, the new reality is this. They can see enough. Now, what exactly is the timeline? The rule applies to transactions carried out in the 2025 tax year. That means from 1st January 2025, US digital asset brokers will be operating under a regime where their 2025 customer activity is expected to feed into 1099 DA reporting. Those forms will then go out in early 2026, just like traditional 1099s do for stocks and bonds. So a US viewer watching this today has one transition window left, the remainder of 2024. That's not a panic and run window. That's a get your house in order window. Because here's the bigger point. Tax reporting isn't anti-crypto. It's anti-invisible. This is where savvy investors shift mindset. Instead of thinking, how do I hide? They start asking, how do I structure my activity so I can keep trading without future headaches? That means a few practical things. You start keeping proper records for 2024, so you're not walking blind into a world where the IRS has a clearer data set than you do. You look at your choice of platforms. If you're using 5 different exchanges, endless swaps, and random on-ramps, you're making your own life harder when the reporting starts. Consolidation isn't just about security. It's about being able to actually reconcile what the IRS will see. You rethink free money strategies. High turnover trading, heavy leverage, bonus chasing, and yield strategies might still be attractive. But if they leave a messy footprint, they could turn into a tax nightmare when every disposal is reported, and you've barely kept track. And most importantly, you drop the fantasy that future enforcement can't touch past years. Because once these systems are live, authorities don't just use them for fresh activity, they use them as baselines for patterns and risk scoring. If your 2025 data looks wildly out of sync with what you've declared for 2023 and 2024, that gap can become a question. Now, let's bring it back to XRP, Bitcoin, and Ethereum, because this isn't just a memecoin story. If you're building long-term positions in large caps, the last thing you want is to be forced selling in a future bull cycle because you've triggered a tax panic or retrospective cleanup. Smart holders aren't just thinking about price targets, they're thinking about survivability. Can I hold through volatility without getting wrecked by the tax man because I didn't prepare? The irony is that as crypto gets more integrated into the mainstream, ETFs, regulated custody, bank rails, tokenized assets, the less room there is for shadow behavior. The same rails that bring in pension funds and big asset managers also bring in clearer reporting, cleaner compliance, and less plausible deniability. And that's not just a US situation. You're seeing the UK align with CARF. The EU is pushing its own reporting standards. Slowly, the map is closing. So what should a US viewer do? First, don't panic. This is not the end of crypto. It's the end of pretending it lives outside the system. Second, get ahead of 2025. Use what's left of 2024 to get your records in order. Exports from exchanges, a clean picture of your past trades, and a basic understanding of how capital gains actually work in your state. Third, talk to someone who lives and breathes this stuff. A qualified tax professional who understands digital assets. Not a Telegram guru, not a YouTube comment. Someone who can look at your position sizing, your trading style, and say, here's how to navigate 2025 without sabotaging your future. Because the real crypto winners in the next cycle won't just be the people who picked the right coin. They'll be the ones who can hold, exit, and rebalance without getting blindsided by a letter, a bill, or an audit. 2025 will be the first true on-the-grid year for US crypto reporting. 2026 will be the first year many people feel the consequences of treating digital assets like a side hustle the IRS wouldn't see. So the question isn't, will the new rules kill crypto? The question is, will you be ready to operate in a world where crypto finally gets treated like every other financial asset? Tracked, reported, and taxed. Because as the rails get built, there are really only two types of players left. Those who adapt while it's optional, and those who are forced to adapt when it's already too late. If you're watching this now, you're early enough to choose which one you want to be. 2026 isn't the year crypto changes. It's the year a lot of US traders finally realized 2025 was the year the rules already switched on. It's not the next bull run that should worry US crypto holders. It's the next tax form. While everyone's staring at charts, meme coins, and ETF flows, the IRS has quietly turned 2025 into the first ever 1099 DA crypto reporting year. A full data feed straight from your exchange to them. And most people still think this is coming in the future. It isn't. In this video, I'm going to show you what 1099 DA really is, why 2025 is the first on-the-grid year for US crypto, and how to avoid getting blindsided in early 2026 when those forms start landing. It's not the launch, it's the trigger.